Good day, traders. Stacey Burke from Stacey Burke Trading. Today we'll review a couple of things and just going over best playbook trade setups. Received quite a few emails and questions yesterday, and I'm just going to go over and review some simple concepts, answer some questions. One of the first things I want to hammer home is this is my playbook, pump and dump. It could be dump and pump. It could be flipped over the other way around. Words might be upside down, but the same pattern applies on the long side for the dump and pump. What I want to emphasize to traders is, again, my mindset, my approach to the markets is about skewing the odds heavily in my favor. I was asked a lot of questions. I put on the post last night, just prior to heading to bed for me, that there were no other setups for me in the New York Open, only the gold trade. That was the only trade that I had yesterday. And what I want to emphasize with that is the difference for me, knowing when I don't want to trade, which markets I don't want to trade, versus pips. So yes, there are pips there to be had. But for me, that was not part of my playbook, and we'll review that. Just take a quick look at this scenario again. This is the 90-10 opportunity that I see for myself trading in the markets. So when I look at the NASDAQ yesterday, I'm in a trading range, and somebody asked me, wouldn't you have saw that as a long trade and a trend trade? And no, I don't see that as a trend trade. I see that as a trading range on level 3. And if I bring my chart together, we have Monday, we talked about day 1 on Friday, day 2 Monday, day 3 low of the week on Wednesday, and yesterday is inside of a trading range. Now I can measure back a certain amount of distance from the previous day's high, from the high of the week, etc. But this to me is level 3. We've gone up on Friday's session, on Tuesday's session, and consolidated at the high. And several traders took trades, NASDAQ, S&P. But for me, this was inside. And yes, and again, on level 3, they will blow off in the direction of the trend. When this occurs, I can already in my head say to myself, this will be a 3-hour setup at least, if it is to give a sell high setup, coming back to that pattern. Again, the pump and dump. The pump and dump is where I get 3 levels of rise, and I can control my risk at the right time with the reversal for the measured move or the collapse. When I'm in a trading range, we can see that set up just prior to the US window, which is the trade that I took on gold, but I don't take that with the indexes. I'm specifically trading the indexes with 3 levels in mind, and this is a level 3 trade. When I'm in a trading range, I do not like to trade these. Now, taking a look at the difference between that and a trend trade, which is again where we have a consolidation and a trading range that is in a level 3 coming out of a breakout trade. The difference being, again, timing-wise, we have the creeping trend down for the continuation, coming out of an explosive move already, versus being in a trading range where I'm trading from side to side inside of peak formations. Coming back to that pattern, on the previous Monday, we see three levels of rise, consolidation, the breakdown in the US session for a scalp trade. We see 3 levels of drop in a breakdown and 3 levels of rise intercession in the beginning of the U.S. markets for the continuation down. We see 3 levels of rise into the New York Open for the collapse, the pump and dump pattern, vertical. We see 3 levels of rise and a collapse into the low of the week for the explosive move back. We saw 3 levels of rise from the U.S. session on the Friday, the consolidation and the breakdown in the London-Europe window, and then the pullback after payrolls for the continuation scalp trade down. 3 levels of rise, stop hunt and the collapse. 3 levels of drop, low of the week for the explosive squeeze reversal trade. And again, the difference, we see 3 levels inside for this scalp trade, but outside of my timing window, versus the gold setup, which happened right at my timing window. And again, emphasizing that with gold, this is a textbook playbook setup. We had a 50 pip box, we had the escalator up, the stop hunt. I'll just remove the green box. We're outside of the range for the 50 pip collapse. Escalator up, 50 pip collapse right in my timing window. Again, the S&P is the same thing. So the point I'm emphasizing is that with the indexes, I'm specifically looking for 3 levels of rise and the pump and dump trade. We had a similar trade setup on the S&P, but I do not trade those setups on the S&P. I'm specifically looking for 3 levels of rise and fall at the New York Open. Again, an example of level 3, we're in a trading range. Historically, this is where, on a Wednesday, day 3, we're inside, regardless of what that may perceive to be. These are not setups that I trade on the indexes. Again, when I see this, pins inside of the low. Now, I know there are traders that got 100 pips on this, and so the emphasis that I'm going to keep reiterating that for me, this is not a playbook setup for me on the index. This is 1 hour up, at least an hour of consolidation. And if there is a reversal, now I know this is at least 3 hours. So again, outside of my timing window because I'm in bed. But for the indexes, this is not one of my playbook setups. Now, out here, if I was in North America, opportunity absolutely at the high after they've taken out the previous day's high. We're inside of a trading range. Yes, I know there are people who say, well, it's a no-brainer, it's going vertical. But yes, there are pips here. But this market stayed inside of the consolidation. So again, my trades happen when they come outside 3 levels of rise or fall. You can see there was an opportunity just pre-market, same trade as gold, but again, just outside of my timing window. And with gold, this, I don't take these on the indexes. My trades on the indexes are 3 levels of rise and fall over the course of the day. On gold, this is a textbook setup. S&P did the same thing. There was an explosive move after the lows, but for me, again, this was not a setup. Oil I had as a trend trade, but again, coming back to timings, the market broke out in the gap and came back inside in our 12-candle window. It needed to come to the low or to the high for a reversal. Now, again, timing-wise, for me, if this is going to be a 3-hour setup, it's just outside of my time. I took the gold trade. Everything else was in a trading range. I decided that that was it. I need 3 levels of rise or fall. Oil, a little bit different, but this breakout and then the pullback told me that the likelihood that this market would revisit the high, but not until it had a stop hunt down to the low. Some traders asked me why I didn't go long. Again, the only reason I didn't go long is I had a 50 pip vertical blow-off trade. The reversal for me on level 3 is not a trade I like to take. And the reason why is that this market, if we back this chart up, we have a V-bottom reversal, but we are inside of a trading range. And this market could have easily just pulled back and retested that low down into the low of the U.S. session because we're on level 3. And if you measure the distance from top to bottom, this is a 150 pip move. We were 100 pips below the previous day's low, 125 roughly to the low. The low to high measurement of 150 pips is a great target, a good trade, just not part of my playbook after having taken the short trade. Again, my goal is not to try and take as many trades as possible. I've got set trades, and that's it. I'm not interested in pips. I'm looking for where my setups are and where I can size into trades. Now, I've talked about trend trades. The carry trade on the US yen right now has been an absolute gift. We can go take a look at the monthly charts. When we look at the monthly charts, we've come out of a major consolidation. There are probably many ways to measure this. We can do a high-low range expansion of that peak formation. It doesn't matter. Currently, we could be in a measured move. If we back this up, this market still has room to go to previous highs from back in the 90s. Now, whether it gets there, I have no idea. But right now, the market, the Japanese government has maintained that they will not change interest rates. And when we go to a smaller time frame, we talked about this market coming out of a 3-day consolidation at an ascending triangle, and we have done measured moves of that, but there have been plenty of session scalp trades for 50, 75, and 25 pip movements. Now, obviously, the further this market goes, the tendency will be to shy away from markets that have gone higher with the belief that they will correct or come back. But again, coming back to some simple concepts, when I look at this market, when I'm looking for a correction, we've had a rise, I will count 3 levels. 3 levels, 25, 25, 25. Now, I keep getting this question. I don't know what you mean by 3 levels. Every instrument will move in 3 levels. It might be 50, 50, and 50. The major pairs typically will move in 25, 25, and 25. So I'm not counter-trending a market like this. But when I get 3 levels of drop, I'll look for a continuation trade into this session for a scalp or over the course of the day. You can take money, you can leave trailers in. This market, I would not counter-trend. If it's an index, it could be 3 100 pip levels. Oil can be 250, 250, 250. Again, the day itself will give you increments of movement. 3 levels, 25, 25. It comes back and stays in consolidation for 3 sessions for a continuation move up of 100, 100, and 100 with the trend. Just to answer a few questions, Ladizwi, I hope I pronounced that correctly. Exactly. This is like my setups are duplicatable. So again, with trading ranges, they're not ideally what I like to trade. I'm not interested in trying to trade the range. I have certain setups, 3 levels, rise and fall, the pump and dump, dump and pump on the indexes. Oil, I look for trend trades. There are going to be squeezes. There are going to be high week, low week trades, but they're 3 levels. With the indexes, again, 3 levels. Those are my best setups. With gold, there are session timing trades, as we just saw, which are pump and dump setups, which can be 50, 100, and then we have our weekly 3 levels opportunities as well. Jungle Jazz. Only had trouble holding my finger pressing the button, too early, loaded gun. Everything is specific to timing, and if you're finding that some of the trades are hard to take, the setups, that's where you should scale down size and just focus on flawless execution of the trade setups. Great question from Vincente. I only see your winners, not your losers. Now, here's what I can say with regards to that. I've had 15 years of losing trades. Everything that I tell you is for a very specific reason. I don't trade outside of my trading times. I take very specific trading setups. I'm only looking for certain setups. I am not trying to get the market direction right every day and get pips. I am looking for my playbook setups. I'll use the analogy that I tell my son. I can give you $1,000 to trade with, and if you lose it, you will learn nothing. But if you take $1,000 of your own money and you lose it, you will learn a lot. You will only learn from your own losing trades. You will not learn a thing by me posting a losing trade. So I hope that resonates well with you. But one of the things I want you to grasp from this is that my setups, my pump and dump setups, are heavily skewed in my favor. Even if they don't move as far as I want them to go, the likelihood of me being on the wrong side gets less and less the more you filter out garbage trades at the wrong times with very little asymmetrical risk reward. So you have to filter out what piker trades are. You need to focus and build your playbook on the best trading setups. You need to know where your losers are coming from and why they're coming. Are you over trading? Are you over leveraging? Are you taking poor quality setups? Are you trading all the time? I have a very, very specific trading plan, and that has come from 20 years of doing everything wrong and right. So I hope that makes sense. Do you generally place your stop loss above the stop hunt high or somewhere else? Whenever I get in the market, my stop is at the high or at the low once that trade is locked in. Coming back to my gold trade, I entered in on the engulfment, and this has to do with timing. So again, the first 15 minutes typically will be a false move in this particular case. What that means is that I'm looking for the entry into the next 15-minute candle, or at the end of the first 15-minute bar. This occurred 9 minutes into the 15-minute candle outside of the high of London, but it had also taken out the pin stop hunt from shorts inside the Asian session. So we're above the Asian high and into the shorts from the initial stop hunt. The engulfment got me a fill price at 15. The pin high in this particular case is at 27. Now, my rationale on this trade is I don't add the spread to the stop, because this trade, if it comes back up to there, the 2 pips is irrelevant and I'm wrong. So in this particular case, I had a 12 pip stop, but I also will look once it comes back inside in that second 15-minute bar to add another position and going to break even as this starts to collapse. This first level, so just again understanding there's volume up high, just like this day on the indexes, we have an escalator with 3 levels of rise. And whenever there's a consolidation and it comes out of that, that's level 1. So again, I'll emphasize to go study your charts. Level 2 is the explosive move. Level 3 is the consolidation, then the stop hunt. But also the important part is the distance from top to bottom must be at least or greater than, for me, in this particular setup, of 50 pips or more. So when we look at our chart, we see the previous reversal in the U.S. session. So the market still had, the reason why I did not want to go long is the market still had the possibility of pulling back and collapsing down for a second touch, or maybe even just a reversal. My initial thesis is the pump and dump setup, 3 pushes into the high, the consolidation, and a minimum of a 50 pip box with my trade occurring outside of that range. This happens on gold quite a bit. Again, that's a gold playbook setup that I have. A great question again from Aniki is, what's your advice on managing many pairs? Don't manage many pairs, focus on a few. That's as simple as that. I focus on gold, S&P, NASDAQ, and oil, primarily for the U.S. session. I'm looking at the majors for 3-day setups, or in the case of the yen crosses right now, session explosions with the trend. That's it. So it takes me 15 minutes to review those. But the U.S. session trades, obviously over the course of the day, I draw my lines and I'm looking for 3 levels of rise or fall. It's as simple as that. Great trade, Miss Simba. So to answer Jeremy's question, can I get your insight on today's New York U.S. session? Again, I can't emphasize it enough. I'm just looking at my geometry and I'm looking for those setups, the pump and dump setups. Classical charting patterns were in a box. So, again, level 3, we're inside of a high and a low. There's a possibility for a sell high setup. Again, my timing window, this trading range, how this played out, this is not part of my playbook. We're at the top of a range inside the high and low from Monday, Tuesday. Possibly a Thursday trade up high for a reversal today or Friday, but I'll be looking for something for 3 levels and a reversal. So this to me was just, again, my playbook, not a trade. Tuesday, 3 levels down. Monday, 3 levels up. These are textbook playbook setups. This consolidation is not something that I want to trade. Yes, there's movement. I'm not trading those. That's not part of my playbook. Had they gone through in the first hour and been working the high in New York for the reversal down, yes. but we did not have the 3 levels. This is a consolidation inside of the high and low, up high on the 3rd level after the big move on Tuesday. So hopefully that makes sense. So hopefully you got value from today's video, traders. Again, my approach is I'm looking for these pump and dumps over 3 days, 3 hours, 3 sessions, trend trades. Again, if we flip this around for the long trade, I'm looking for the market to correct for the continuation with the trend on the carry trade. But just for explosive continuations, if it's a 3 levels trade, maybe leave a trailer in. But over the course on the indexes, gold, there are textbook playbook setups. Not every movement in the market needs to be traded. I don't want to overtrade. I'm looking for my best trade setups. I don't want to be in the market all the time. I want the odds skewed in my favor. Timings, high and low, 3 levels. It's as simple as that. So keep it simple, traders. Have a great day, and may the markets go with you.